Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Friday. It is Friday the 20th. It is the last day of the third week of August. We are in smack middle of dead of summer, and there's lack of liquidity and a lot of news. That's a recipe for volatility. And as you can see here, the Dow is down about 148 points. The Nasdaq is down 28 points. The S&P is down 16 points. This is anything but random, and I'm going to tell you something. I hate to pour salt on the wound, but who told you that volatility was going to start picking up like crazy? Who told you that we were having divergence? And who's telling you that put to call ratio is going nuts? I did. Before all this happened, last week, look at last week's video. So let's talk about this week. The most important thing you need to pay attention to right now is the put to call ratio. The put to call ratio is very, very bearish. As you can see here, we're at the highest level we've been since middle of 2020, 5/2020. We're in 8. This is the highest level we've seen in 15 months. So the markets are very, 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 very nervous right now. Remember what I told you a few days ago, or maybe it was yesterday. I lose track of days. Whenever the put to call ratio gets 70 or lower, that means markets are really greedy and they're going to turn. Whenever the put to call ratio gets above 1, that means markets are getting scared and they're going to pull back to the other side, to the bullish side. So right now, the put to call ratio, as I mentioned, as you can see here, this is the highest level we've seen in a year. Now we go to 2 years. We're not at the COVID levels, but volatility is picking up. Now, typically, unless we have like another major close down, I don't think that's happening. I think we're going to peak around here. I think we're going to get stretched out around here. And I think that's going to be it. I don't think there's going to be much more. Typically, usually, unless there's some craziness happening, that's about as high as it's going to go. So I'm expecting the market to turn around. As far as the S&P is concerned, the regular S&P, we're still trading above the 50-day moving average. But I think what's going to happen is we're going to bottom out today, and then we're going to start closing a little bit higher. But I don't think this is going to really take us down too much because the put to call ratio and volatility. Let me show you volatility. Where's my volatility? Let me just go to VIX. And put to call ratio typically rises with volatility because volatility typically rises when markets are fearful. So as you can see here, volatility level is now above pre-COVID levels, but it's still fairly low. There's a good chance it'll come back down. I'm not expecting a major downturn right now because we're smack middle, well, not middle, but we're towards the end of August, and there's just not a lot of major catalysts right now. Now, if you look at the Nasdaq is almost at the 50-day line. And if you look at the equal weighted S&P, it's way, 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 way at the 50-day moving average. Now, let's take a quick look at momentum levels because we haven't looked at momentum levels in quite some time. Currently, 30% of stocks that are trading above $2 are trading above the 50-day moving average. So the market is, in the short term, the market is bearish. Stocks over $2, you only have 50%. So we're literally sitting at the 50-day moving average right now, at the 200-day moving average. So in my opinion, the market should look a lot more like this, sitting closer to here. 50% of stocks are at the 200-day moving average. That's not happiness. That is far, far, far from happiness. So my point here is the market is a lot more bearish than you guys believe it to be, or that it looks. As a matter of fact, if we look at the Nasdaq indice, the number of stocks trading above the 50-day moving average on the Nasdaq 100 is right now 57%. Let's look at the number of stocks in the Nasdaq composite, 34%. 34%. Number of stocks at the 200-day moving average, 52%. What about the Nasdaq 100? 72%. So as you can see here, there is still a huge, huge, huge market capitalization issue in the market. It's getting a little bit better, but it's not really going to resolve itself till we have a good pullback, and I mean a real good pullback. But with the put to call ratio and the time of year, I don't think we're going to have one right now. But I'm going to show you we're still extremely fragmented. Look at technology and look at consumer discretionary. Till they're next to each other, the markets are going to stay fragmented. But I do believe the put to call ratio right now, it's not going to go higher. I don't think there's a major global catalyst right now to cause it to go higher. I don't think we're going to have lockdowns. I think everything we know about COVID from the first pandemic move is already priced into the market in terms of fear. I don't think we have as much of an unknown factor as we had in February and March of 2020. So I don't think we're going to have as big of a panic, but I think the markets are going to bottom out next few days because the put to call ratio is really high and there's nothing really as major as the first COVID attack. So I don't think it's going to go much higher, maybe a little bit more, maybe it'll get stretched out, and then I think we're going to go bullish once again. Now, I've got 3 stocks that have pulled back substantially, and there's a lot of pullbacks, so I've tried to find the best ones for you. First one is Diageo. They make booze. What do you do when markets are breaking down? You buy booze, of course. What else would you do? Alcohol. Smirnoff. Anybody want some Smirnoff at 7:16 in the morning? Johnny Walker, JB, Malibu, Guinness. Ooh, they make Guinness. I used to drink Guinness. Guinness is a good beer. Anyhow, the company's looking really, really good. I like the 40% return over the year. I like this pullback. I like the fact that the RSI is not going nuts, as you will see in about a second here. Yeah, it's not overbought. It's coming off. So I like DEO. Next one, GFL, environmental company pulling back to the 50-day line from a swing high. RSI is not overdone. And if you look at the profile of the stock, you'll see environmental services, non-hazardous solid waste management, infrastructure. When you start building stuff, you get a big mess. You need to clean a lot of stuff up. What do? Environmental services. Waste management is huge in America. The laws in U.S. My mother-in-law used to be in waste management for one of the biggest oil companies in the country, and the laws we have in this country are nuts. We have to the cleanup rules are very, very precise. So there's going to be a lot of money in waste management. This environmental company, I'm looking for big, big gains from it. And again, 50-day line from a swing high. Next, AMKR, Amkor Technology. 50-day moving average from a swing high, all-time high, I believe. Let's take a look. Yep. Nice little trend. And what do they do? Semiconductor, largest independent provider of packaging. Remember, when it comes to gold and shovels, the shovels always outwin. So it doesn't matter which semiconductor, packaging, testing and packaging. Folks, semiconductor testing and packaging is huge right now. And this is a Russell 2000 stock, 81%, market cap of less than $6 billion. I'm loving what I'm seeing right now. This is great. Earnings growth, 311%. This is good stuff. Earnings per share versus previous quarter, 121%. I'm in love with this stock. Amkor Technology pulling back from a swing high. Folks, what else can I say? I think we're going to come back up. I don't think the market's going to. I think there's not a lot of institutional traders right now to really take the market much lower. And I think this morning fiasco that you're seeing with the market down almost 0.45, I think it's lack of liquidity that's causing a lot of volatility. And I think over the next couple of weeks, things will stabilize. But the fact that the put to call ratio is already at 115 tells me that rubber band is pretty stretched out and that we're going to come off of these lows sooner than later. Now, I got something important for you, something timely. Former Air Force pilot and $1 million investor Chuck Hughes, he's getting ready to disclose his brand new trading discovery called Omega One. He's revealing it to a select group of traders, and guess what? My viewers, you guys, you're invited. Not only, check this out, I'm excited about this. Not only will he reveal this pricing anomaly that's recently paid him 104 times out of 108 trades. Yes, it paid him 104 times out of 108 trades. But he's going to put $3.4 million on the line to help traders just like you succeed with his new innovative formula. Man, you got to check this out. You got to check out this formula, this Omega One formula. Folks, there's only one thing left to do. This is happening next week. I'm super excited. I'm going to be hosting it. It's going to be a great time. You're going to get a lot of education, and you're going to get actionable trading advice. Not advice, actionable trading information. That's better. Click on the link below to learn how you can unlock Chuck's 𝗎𝗍 trading strategy. Do it now before we get packed. I mean, this is the hottest launch we've ever had. And make sure to like this video, subscribe to this channel if you're watching on YouTube, and stay ahead of the market by being the first to be notified when I post my next video, just for you. But most importantly, click on the link below and learn how Chuck is going to put $3.4 billion on the line for this 𝗎𝗍 104 out of 108 winners. How can you afford to miss it? Follow the link below. Get in on this now. Bye, guys. Have a great weekend. Talk to you soon. Get some rest. We're going to have some volatility.